$4.3 billion. That's what one crypto exchange agreed to pay U.S. regulators in a single afternoon in November 2023. Its founder pled guilty. He resigned as CEO. He served 4 months in federal prison. The exchange was Binance, the largest crypto exchange in the world, processing more volume than the next several competitors combined. And the government didn't shut it down with some exotic crypto-specific law. They used the same Bank Secrecy Act playbook that applies to every bank and MSB in this country. I spent over a decade investigating financial crime. Here's exactly how a compliance failure this size actually happens, and how regulators built the case. Before the mechanics, a myth to clear up. Binance wasn't shut down because it got hacked or because a coin collapsed. It was shut down for the same reason a small check casher gets shut down: the Bank Secrecy Act. The indictment charged 3 things. 1. Conspiracy to violate the BSA by failing to run an effective anti-money laundering program. 2. Operating an unlicensed money services business. 3. A willful violation of U.S. sanctions law, the International Emergency Economic Powers Act. Same statute, same regulatory category, MSB, that applies to a single location check casher in Ohio, just at a scale of billions of transactions instead of thousands. That's the part worth sitting with. This wasn't a new kind of crime. It was the oldest kind of compliance failure, at the biggest scale anyone had ever prosecuted it. Failure point 1. There was no real anti-money laundering program behind the interface. Public court filings describe a know your customer process that, for years, let users open accounts and trade with minimal identity verification. Internal communications cited in the DOJ's filing, Binance's own compliance staff in writing, flagged that the exchange was serving customers in sanctioned jurisdictions and processing transactions tied to ransomware, child exploitation material, and terrorist financing. A real BSA program means someone is actually looking at the alerts a monitoring system generates, actually filing suspicious activity reports, and actually declining or exiting relationships when the red flags say to. Prosecutors alleged Binance had the technology to detect this. What it didn't consistently have was the will to act on what the technology found. A pattern regulators have hammered banks for domestically, at a fraction of this scale, for years. This is failure point 1 because everything downstream depends on it. If nobody's filing the reports, nothing else in the system catches what's happening. Failure point 2. Binance told U.S. regulators, publicly, that it didn't serve U.S. customers, while allegedly working to keep them anyway. Binance never registered as a money services business with FinCEN, and for years maintained it wasn't required to, because it didn't operate in the United States. Prosecutors alleged the opposite was true internally, that Binance instructed U.S.-based high-value customers on how to bypass its own geographic restrictions, using VPNs, offshore shell entities, to keep trading on the platform, while the company's public position was that Americans weren't welcome. This is the part that turns a compliance gap into a criminal case. A bank that's genuinely bad at catching red flags has a program problem. A company that is privately telling customers how to evade its own controls has a different problem entirely: willfulness. That distinction is exactly what separates a supervisory finding from a guilty plea. Failure point 3. Sanctions. The sanctions charge covered transactions connecting U.S. users to entities in sanctioned jurisdictions, the kind of activity a functioning sanctions screening program is specifically built to block at the transaction level, not just at account opening. This is where the FinCEN piece of the settlement gets its size. Of the $4.3 billion total, FinCEN's own civil money penalty was $3.4 billion, the largest in the agency's history at the time. FinCEN's resolution also imposed a 5-year monitorship and required Binance to fully exit the United States market. Separately, Changpeng Zhao personally pled guilty to a Bank Secrecy Act violation, paid a $50 million fine, and served 4 months in federal prison after stepping down as CEO. 3 failure points: no real program to catch it, an active effort to keep U.S. customers while denying it publicly, and sanctioned jurisdiction exposure sitting on top of both. Any one of those gets a bank and enforcement action. All three, at this volume, is how you get the largest corporate criminal resolution in the history of the crypto industry. Here's why this matters if you're not running a multi-billion-dollar exchange. The compliance monitor, now sitting inside Binance for 5 years, reviewing internal documents, evaluating the AML program, reporting to the DOJ, is the same tool regulators use against community banks and MSBs that get into trouble, just scaled up. The independent review concept, the someone outside the building checks your program, isn't a crypto-specific invention. It's standard BSA remediation. And the smaller the institution, the less room there is to survive this, the way Binance did. Binance had $4.3 billion and a business model that could absorb a 5-year monitor. A single location MSB, a community bank, a regional crypto platform, doesn't have that cushion. The program failure that costs a giant billions in penalties can simply end a smaller institution, which is the actual lesson here. The fixable version of this problem is cheap. An independent program review, red flag testing, someone qualified checking the KYC and sanction screening process before a regulator does. That's a fraction of the cost of finding out the hard way. So next time a crypto exchange, or a bank, or an MSB gets hit with a 9 or 10-figure penalty, you'll know it's almost never one dramatic failure. It's the same 3 gaps, over and over. No real program behind the interface, activity that contradicts what the institution tells regulators, and sanctions exposure nobody's actually screening for. I'm a CAMS-certified financial crime investigator with over 12 years in this field, and I built fourth pillar compliance to be the independent check that catches this before a regulator does. Program reviews, red flag testing, and interim BSA-officer support. I left the same free red flags checklist in the description. If you want to understand how these cases actually get built, not the headline, the mechanics, subscribe. Educational only, not legal advice. Everything here from public court filings and regulator press releases. I'll see you in the next one.